in. So the first thing that we're going to cover is financial modeling. How do you build good models? So this question is primarily directed to those of us who are in the advisory space. You can work for a corporate finance firm, or you can work for an investment bank, and you have somebody with deep pockets who comes to you and says, we need advice. This is our feasibility study. These are all the technical reports that we've done, and this is a preliminary model. And we need to raise funding. We need you to develop a model for us that is fit for an investment bank or fit for whatever private equity firm that we are about to approach. And they need to do a valuation on our business to provide us with capital that we need in order to get us going. So the first question that you'd need to ask yourself if you are working in this investment bank and you now get this client coming to you is, why do you build a model in the first place? What's the purpose of doing so? If you look at this graphic on the right-hand side, it's just a word dump or word cloud of many words that people would use to describe financial models. They're chaotic, they're useless, unreasonable, cluttered, ineffective, bulky, error-filled, etc., etc. So a lot of people use modeling as a departure point to say that if Excel tells me that this is a good project, it must be a good project. And nothing could be further from the truth. Models, looking at the quote at the bottom of the slide, essentially all models are wrong, but some are useful. And that's George E.P. Box. He's a famous statistician. And why would he say that? In your personal experience, especially if you were born in the 80s, you're part of what's called the crisis generation. So you have experienced a whole number of financial crises or global economic crises in your lifetime. And so if you used models to try and predict the future, especially if you were to develop a model in 2007, for instance, or develop a model in 2019, chances are that model is not going to tell you much by way of predicting the future. So there needs to be a very well thought out process as to why you need a model in the first place in order to guide you when you're actually building a model. So why do we build models? I'm going to come back to the slide. In 2015, as I mentioned before, we saw that great commodity price crash. And what I learned on the job is that you couldn't really use modeling only as a predictive tool. You had firms in our portfolio that had good models and who had good financial departments. And you also had firms that had financial departments that left a bit to be desired and financial models that left a bit to be desired. So what was the difference between the two when that great crisis hit? If you have a good model, you can ask yourself the following three questions and you can answer the following three questions with a great deal of accuracy. What are those questions? Let's look at the first one. How long can we survive in this current environment if we adopt a business as usual approach? So your model should have sufficient granularity or sufficient detail to cover all the operational costs, capital expenditures, production profiles, and just give you a general snapshot of how your business performs in a business as usual approach. You would then need to build in certain stress testing capability in order to enable you to answer this question. So given 2015, where we saw iron ore drop to around about $30 or $20 a ton, if I was to plug that into my price deck of the model and I left all my production and cost assumptions the same, I could then get a figure that maybe we have a year in this business before we have to do something drastic. Maybe we have a year before we have to drastically change our mine plan, file for retrenchments. How long do we have for a business as usual approach before we have to do something major? The next question is, where is the low-hanging fruit internally? In other words, what can be cut now or capitalized upon now to ensure that we can weather the storm without doing any long-term damage to the company? If you have a good model and your model is sufficiently detailed, you would then have all of your major pain points in your business itemized and in a dynamic format in Excel, such that you can see that if we cut our trips to the pit by 50%, this is how much we save in fuel and labor, but this is how much we lose in revenue. Is it an optimal trade-off? If you have sufficiently detailed block models, which show the production profile, and those are typically done by your geologists and your mining engineers, and you say, if we mine pit 1 and pit 2, and we stop mining in pit 3, because pit 1 and pit 2 have high grades, therefore low cost, will that do a lot of damage to our long-term mining profile once prices recover? In other words, is it worthwhile us shutting down a pit in order to be break even during this commodity crisis? Or should we keep pit 3 going, even if it's operating at a loss itself? Because in the long term, if we shut it down and we try and open it up again, it would cause more long-term damage to the business than any benefit that it would accrue to the business. So if you have a suitably detailed model, you can also answer that question. The last question: are we actually viable as a going concern in future? And if so, is there anyone out there willing to save us if we can't save ourselves? So this is where the valuation aspect becomes very important. You need to be able to know what the value of your organization is, and you can then do some comparables. You can do what we call comps and see that, if you were to issue equity, for instance, at this stage, you value your mining company at a certain number. Is it lucrative for people to invest additional equity during this downturn? Is the mine itself a going concern? Do you need business rescue? Are you willing to shop off your organization to maybe a bigger player in the mining space? In order to answer that question, you need to have a robust financial model that can give you reasonably accurate valuations. And in order to do that, you need some accurate information in your model. So just looking at that graphic to the right, the World Economic Forum is now in the business of a great reset post-COVID. So really, if you're only relying on your models to tell what the future is going to hold for your business, I ventured as a guess as nobody really knows what's going to happen. What is this brave new world that we are living in? So it's very difficult for you to use your models solely as a predictive tool. However, it's still very important to have a good model so that you can answer those 3 questions. Okay, you can benchmark yourselves against your competitors, and you can know how long you can survive in this current environment, what the value of your business is, where the pain points of your business are, and where the strengths of your business are. You can only answer those questions with a robust financial model.